One of the greatest investors of all time, Warren Buffett has built a multi-billion-dollar fortune by making investments through his company Berkshire Hathaway. Buffett is a wonderful wit as well as a great investor, and he loves to impart his common sense knowledge to other investors. He offers guidance on a wide range of subjects, including investment and life in general. But let's focus on Buffett's money-making ideas for the time being. Here's the surprising thing. Buffett's wisdom seems so common sense and practical, and yet it can lead to great wealth. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Your skills can't be taken away by inflation. Shareholders were concerned about how to prevent themselves from losing buying power as prices rise. With inflation at its highest level in 40 years, being extraordinarily good at something is the best thing you can do. According to Buffett, whatever skills you possess cannot be diminished. They cannot even be inflated away from you. According to Buffett, people will always be prepared to trade some of what they generate for what you deliver if you're the greatest at what you do, even if the way you get paid or the amount changes due to inflation. Anything that helps you better yourself is, by far, the best investment, he declared. Number 9. After all, you only find out who is swimming naked when the tide goes out. Investing might occasionally seem simple. Long-lasting bull markets are possible, and rallies can be ferocious. Buffett, however, argues that we only discover who is truly shielded and equipped to weather the storm when times are rough. Buffett has occasionally inadvertently come out as out of touch with the times during the course of his career as an investor. But eventually, the situation changes, and those who earlier appeared intelligent are found to be swimming without their swim trunks on. Always check to see if your portfolio is set up to withstand a bear market. Number 8. You don't get paid for activity, you only get paid for being right. There's no shortage of stock market commentators and analysts prepared to advise you on how to manage your money at any given time. Buffett warns investors that being a frequent trader who continuously changes positions will likely result in high returns. In the realm of investing, activity can appear to be productive, but the only thing that counts is whether your analysis was accurate. Number 7. If you like spending 6 to 8 hours per week working on investments, do it. Buffett has long suggested that rather than attempting to pick individual firms, investors should use index funds to participate in the market. By choosing specific stocks, you are competing with the experts who have significant company knowledge. However, if you invest in an index fund based on the Standard & Poor's 500 index, you will own the market, which is the benchmark that investors are striving to surpass. Don't hesitate to invest if you enjoy it, but for the most part, index funds and staying away from stock trading will benefit most investors. Another benefit of using index funds is the quick diversification that lowers risk. Number 6. The stock market is a no-call strike game. One of Buffett's most well-known quotes, it captures the essence of seizing the moment. You don't have to invest until you come across a chance that appeals to you and satisfies your criteria for potential profit for the risk you are taking. Once more, Buffett advises investors to hold off on making a purchase until they discover a chance that is unlikely to result in a loss. You are not required to gamble on a stock that you don't find alluring. Number 5. The most important quality for an investor is temperament, not intellect. Once more, Buffett discusses the need of temperament over intelligence for a successful investor. Investors should evaluate what is happening in the market, regardless of who likes what stock, as opposed to trying to follow or go against the majority. Investors might choose better options and make less emotional decisions by concentrating on the objective facts. Number 4. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett advises value investors to purchase great companies instead of just the cheapest ones, i.e., those with stronger economics and competitive advantages. The fact that great companies almost never appear cheap, in contrast to fair companies, may contribute to this problem. However, a business with a strong competitive advantage is more likely to make money over the long run and can save you from making a costly purchase. A fair business might falter and never return to your purchase price or above it, which might not be the case. In a similar vein, Buffett has long been a shareholder of Bank of America, a financial institution with locations all over the country and a prestigious deposit franchise. It holds the second largest investment in Berkshire Hathaway's portfolio as of the second quarter of 2022, and the stake is valued at more than $32 billion. Number 3. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. Buffett contends that investing has a great deal to do with an investor's behavior. Contrary to what other investors believe, Buffett grows anxious when stock prices are driven up by greedy speculators because he knows that a market crash could soon follow. Buffett, on the other hand, becomes more interested when investors abandon a market or a particular stock because prices are lower. Stocks that are less expensive don't carry the same risk as those that are more expensive, and that is how Buffett approaches preventing losses. Early in 2020, the market crashed as COVID-related investor jitters spread. However, despite the panic, some investors plunged into the market, and the market erupted into a ferocious rally off of its lows. Number 2. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Here, Buffett advises acting swiftly and forcefully when you spot an opportunity. You should invest heavily when the odds are in your favor, such as when stock prices are down significantly, since good prices might not come around again soon. When the markets are severely down, Buffett frequently adopts this strategy. When times are good, he accumulates a large sum of cash, and when times are bad, he invests aggressively. He can use this tactic because he has a lot of safe cash on hand. Number 1. Ever lose money? Although Buffett's argument here appears straightforward, it is actually deceptively difficult to understand. Naturally, your goal as an investor is to make money in the market, but one of the greatest ways to achieve that is to limit your losses. What's left after eliminating choices that put your portfolio at risk of loss is more likely to result in a gain. Gains compound more quickly when you have more money in your portfolio. This strategy has effects on how you invest. According to Buffett's statement, you should first try to minimize losses before looking for gains, rather than aiming for the greatest potential upside. Investors who see the stock market as a slot machine have a distinct mentality. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.